Hey, everybody. I appreciate everybody joining today for the third session in this coaching program. This video series is going to this series is going to cover breakouts. Now, realistically, I doubt, maybe if we're lucky, I can get through everything I want to talk about with breakouts in this session. I doubt it. There's a lot to cover with breakouts. And therefore, what I'm going to be doing, I asked everybody to watch the videos. Again, I'm really happy if everyone is watching these videos. People are saying there's an echo. There shouldn't be an echo. I can hear it from this end, but if there is, just keep commenting. Back to what I was saying. I asked everybody to watch the video series of breakouts videos. I believe it's 15 over the past week. The goal with these series is I need everybody to be watching the videos. I am not going to take every slide and basically mimic what's already in the video course. What I'm going to do is take every bullet point and touch on what I feel like are the most important pieces. So, goal number one, you've got to be able to have seen the videos. Then we're going to do a deep dive into it. So, with that said, the first part that I'm going to discuss is the first topic is what is a breakout. So it's video 15A, if I remember correctly, within the video course. That's what I'm going to cover. I'm going to use the whiteboard and I'm going to go over some basic examples. At the end, I'm going to host a brief Q&A session. I will answer some questions and ask some questions throughout the video series. So with that said, let's get started. And thanks everybody again for joining me. Let me just share my screen here. If there is an echo, close out what you're using and then reload everything. There we go. Okay, so with that said, I'm going to get started discussing what is a breakout. Now, while I'm answering this question, who can tell me, how would everyone define this part right here? What is a breakout? What are some things people can tell me about regarding this piece here? So, what is a breakout? For those of you who have studied Al long enough, you know that a breakout is when price goes for the E-mini. We'll just use the E-mini as an easy reference. Let me adjust the mic, it's in the way of the pen. One tick beyond the extreme. So we have to define what the extreme is. The extreme can be the prior bar. And by prior, what I mean is previous. So when you're writing algorithms or codes, people often reference brackets 1, that means prior. The prior, that's just kind of a fun fact. It can be prior bar, it can be prior several bars, it can be a breakout of the EMA, or it can be a breakout of a series of bars that we could call a trading range. Now, when we think about a breakout as a whole, there's one critical piece that we have to understand regarding breakouts. Let's pull up a chart for just a second. And let's just I'm going to go to a blank chart. I'm going to pull up the 5-minute EMA. And this is cruel. While I'm pulling this up, I want everyone to comment and tell me what's the most important thing regarding a breakout. Who can tell me? I'm just adjusting something really quick. There we go. And what I mean by that is, what causes breakouts? So we can see, even here, a breakout can be a gap, it can be price, it can be bar 4, bar 5 going above bar 4 right here. It can be a series of bars 12 to 18. That's what happened actually today at the end of the day. We had this right here. We had a series of bars creating one large breakout on, I'm going to move me out of the way. It can be a series of bars like here, bar 62 all the way to 69, or it can be a few bars. On a 15-minute chart, it's just 3 bars up. So a breakout, the most important things we have to remember is a breakout can be price going one tick above or below the prior bar, or it can be price closing beyond an extreme, like 41, closing above a lot of bars to the left. It can be price closing above several days of the range. So a breakout, you have to remember, is basically breaking out of anything. So that leads to the question. Zoom out a little bit. Breakouts, what's most important here is breakout of what? It's a question I like to ask myself. What is the market breaking out of? Obviously, if the market is just breaking out of the past prior bar right here, so that's one bar ago, if it's breaking out below or above the prior bar, that is a lower probability breakout. It's probably not going to go that far. Now, if it's breaking beyond the past, let's say several bars, let's say it's breaking beyond the past 50 bars to the left, that is obviously a much higher probability breakout. So if we go back to over here, a breakout like this, when it's breaking above several bars and several things, that's a very strong breakout. Who can tell me what are the reasons this is a strong breakout? Who can tell me in the comments really quick? Obviously, one is the EMA. And there's something about these bars right here that make me think this is a really strong breakout. And I'm highlighting it. It's one of the most important things traders should look at. Someone got it right. No overlap. Who said that? I want to see here. Dennis, good job. No overlap. Very little overlap on a breakout is important for several reasons. One is the less overlap we have on a breakout, the more traders that get trapped. So all these traders here who sold and scaled in higher, they are now holding losing positions. And because of that, those traders, if they sell, scale in, and scale in, they're going to be forced to have to exit their trade rather quickly, or else they're going to take a big loss. I show this example here all the time on in this PowerPoint series right here. I'm going to go ahead and screenshot it and put it in this whiteboard because I want to talk about it. So right here, strong breakouts trap traders. And if we look right over here where this blue is, what this is doing is it's basically, I call it cascading breakouts. Any trader who is long and scaling in lower is facing a ton of risk. So they're long, they scale in, they're getting trapped. And the more this breakout starts to close beyond the extremes, the greater the move is going to be, as these traders are having to bail out of their position in essence. And what that causes is a bunch of trapped traders. But we'll talk more about that later on. So a breakout, just to recap, one tick beyond an extreme. Now, because of that, there's only actually one type of bar that's not breaking out above anything. Who can tell me the answer? There's one bar not breaking out of anything, and that is an inside bar. So IB, an acronym for inside bars, do not break out of anything. What that means is inside bars equal trading range bars. Now, the important thing to realize about inside bars actually lower the probability of breakouts. And if we look at inside bars, we just kind of glance at various inside bars. Every trading range is going to be a variation of an inside bar. Here, tight trading range, it reduces the probability of breakouts. That also means, and we'll carry further into this with breakouts later on, inside bars are pullbacks. Now, the reason I wanted to bring up inside bars is if you look at a chart, I haven't tested this over hundreds and hundreds of days, but if I had to guess, there's probably about 8 to 10 inside bars on an average day. And what that means is there's probably at least 70 ish bars breaking out on a 5-minute chart. So a 5-minute chart. And the reason I really want to explain that is that means 90% of these bars are breaking out of something. Usually it's one tick beyond the prior bar or one tick below, one tick above. Sometimes it's something like this, breaking far beyond the extreme. One of the ways I measure strengths of breakouts is I'm going to measure the strength of a breakout based on the moving average. If we have a lot of bars above, I want a breakout to break far beyond the extremes. Again, we'll cover more of that later on. So next, let's go back to the whiteboard. We've understood what is a breakout. So to cover this last piece, what is a breakout? A breakout is one tick beyond anything. That's the way I define it. Now, when I'm trading, obviously, I'm going to have a stricter criteria as far as what a breakout is. So next, the 80% rule. So we'll make this, here is number 1. Number 2, 80% rule. Most breakouts fail. Now, most breakouts fail. This is true to a degree. Who can answer that? Why am I saying that most breakouts fail to a degree? The reason I'm saying that is this statement, you have to have when we say most breakouts fail, there's got to be a reason behind that. Most breakouts, we have to identify what is success and what is failure of a breakout. By definition, most breakouts do fail. If we just look at bars, they fail to go that far. Bear breakout, failed. Bull breakout, failed. However, this simple statement is true. Most breakouts fail to start over the market cycle. So we have to identify really quick what that means. Most breakouts fail. What it means to me is most breakouts fail to start the market cycle over. So we got to go back. And for those of you listening to this right now, I'm thrilled that y'all are listening, but I really want everybody to make sure that they're watching the prior videos. These videos are going to build on each other. So we talked about market cycles last week. Now we're talking about a breakout. What we have to remember, I'm going to kind of give a little bit of I'm going to go up here because we really need to give a short recap of last week. So last week's recap in just a few words is market cycle is a breakout that evolves into a channel, that evolves into a trading range, that evolves into a new breakout. And a cycle implies never ending. So, what we're focusing on here is 80% of breakouts fail to reset the larger market cycle. So 80% of the time, the market fails to go from trading range to a new breakout, which is a new MC. We'll define it as market cycle. So today, what we're talking about is this section here. 80% of the time, the market is going to fail to start over the market cycle. In other words, even here, big bear bar, it failed to start the market cycle over. Here, big bear bar, it's a breakout of this, but really, look to the left. It's still within the overall trading range. This changed the market cycle, and you can see what happened. When we go back over several days, obviously, we're talking about this. Obviously, the market cycle changed here. If we go back over a series of days and we just look at several days, there's plenty of other days. Here, broad bear channel, it evolved into a trading range, but broke to the upside. This changed the market cycle. So 80% of the time, most breakouts, what are they going to do? They are going to go back and forth. And I'm going to share, this takes just 1 second, but I want to share a quick screenshot of one thing really quick. So let's go back to this. So 80% inertia rule. Make sure everyone can see this. 10% of the time, you get a strong breakout like this that leads to a new market cycle. Spike, pullback, and channel. Here, big bull breakout, rally, another leg up, big bear bars, second leg down. But the reality is, even with all of these bars here, look at this. This is a breakout, but it's still part of the trading range. Bull breakout here, still part of this trading range. And it ended up being part of the trading range, but it led to 3 legs up. Big bear bars here, part of the trading range. And look at all the in between. Bull breakout bar right here led to a second leg. Bear bar here led to a second leg. So if we go back to what we were talking about, the 80% rule applies to the market cycle changing in a big way. And what I mean by that is 80% of the time, I'm just going to move this over here. %80 of the time, the market now, you can often, if we think back to a breakout, just because 80% of the time, by the way, if the broadcast is blurry, change your settings on YouTube. So it should be at the bottom right or top left of the video. Click the little settings icon, change it to high. There should be high quality. So change it to that or check your internet. Now, if 80% of the time the market fails to do something extreme, in other words, it fails to break out in a big way, then what can happen after a breakout? So if 80% of the time, most breakouts fail 80% of the time, what happens the other 80% of the time? 20% of the time, so 20% of breakouts lead to a big change in market cycle. So let's find an example really quick. One example is going to be, I'm going to pull this up really quick. I'm looking down because I'm using my other computer because there's a few things I want to share. Here it is. 20% of the time, you get this. So this is part of that 20%. And what you can see is we have a very big bar ending the prior market cycle, and it leads to a new market cycle. So 20% of the time, you get strong breakouts that lead to more than measured moves up. That's why breakouts are so important. The other reason breakouts are important is they cascade on higher time frames. So, for example, the daily chart, you get a bull breakout up here. This is going to influence the daily and then the higher time frames, such as the weekly chart. So, it's really important to understand that the bigger the breakout you get on the time frame you're looking at, it can cascade to higher time frames. By the way, I'm going to share. So, what I'm going to do, let's just do a little housekeeping really quick. So I'm going to go back to here. I'm going to share a few of you asked for the whiteboard last week. I'm going to start using the whiteboard more frequently because I don't want to just read off the slides. I really want to add my thoughts to the whiteboard. So what I'm going to do is, if you go back to getting through the Brooks trading course, number 2. So if we use search this session, you should see the whiteboard and you should be able to download it. It's really wide, so you've got to be able to download it on your computer. What I'm going to do after this session is I'll make sure the whiteboard gets put here. So for those of you that go to the Brooks trading course, scroll down, you'll see the whiteboard here. Obviously that is the whiteboard for last week, so we'll get that updated. So don't worry about taking notes and trying to write down everything I'm writing down. I will share it. So to recap, the most important thing, what is a breakout? Or 80% of breakouts fail. The most important thing to realize is 80% of the time, breakouts are minor. Today is a great example. 80% of the time, you get these big bars, they get minor second legs. So big bull bars, a small second leg up, then a reversal. Big bear bars here, a small second leg to the downside. Bull bar, and then a reversal. That happens most of the time. Less times, you get something big like this. So bullet point number 3, Why are reversals breakouts? And I'm curious, while I'm doing this, does everybody enjoy me reviewing each bullet point one by one and talking through it? Right now, that is my plan. And unless someone can prove to me a better way to explain it, then that's what I'm going to stick with. So, reversals. So, reversals are the same as a breakout. So, let's think through that for a second. Why is a reversal and a breakout the same thing? The reason it's the same thing is in order to get a reversal, you have to have a breakout of something. So, in order for the market to reverse, you must break out of the bars to the left. So, let's think about that for a second. If we have let's say we have a rally. So, we have a bull bar here, pull back, and I'm going to use a line chart. Second leg up, pull back, and then a small third leg. We could call that a wedge. Now, let's say this third leg, as it rallies, let's say it starts to go sideways. Starts to pull back a little bit here, and then it starts to do this. So it starts to go sideways in a tight trading range. And then it tries to break out to the upside, but then you get this big bear bar. So you start to get here. So you start to get a big sell off. That is reversing the bars to the left. So it's reversing all of this. Therefore, it's a breakout. It's also reversing the price action from here. So over to here, this is all getting reversed by this bear breakout. And because of that, what does that mean? You can get a rally lasting, you can get a bull bar, you can get a series of bull bars, and then a pause, and then a breakout. So you can get a bull bar here, another bull bar here, and then another bull bar here. You can get that. And then you can get maybe sideways trading for several bars. And then you can get a big bear bar down here. That's a reversal. But this reversal it's a reversal and a bear breakout. Or you can just get a big bull bar here and then a big bear bar here. That's a 2-bar reversal. Lastly, you can also have this where the market rallies up to here, fails, and then it sells off down here. That's a 2-bar reversal. So every reversal we see on a chart is going to be a breakout. So right here, we sold off, we went sideways. We sold off, we went sideways and broke to the downside. And then the market reversed up. This reversal here is going to be a breakout. So that is really the most important thing to realize about breakouts and reversals. Another example would be something like this, where the market is selling off and reversing to the upside. A reversal and a breakout are pretty much going to mean the exact same thing. So you get a rally, it goes sideways, and then reverses up. So that's really all you need to know about breakouts and reversals being the same thing. Some people asked about typing on the whiteboard. I'll look into that. The problem with that is it's not really that easy, especially when we start talking about charts. But I will consider that. So lastly, next piece, trading range means buy low, sell high, and scalp. So the third piece, it's actually the fourth piece. Now, does everybody know what buy low, sell high, scalp means? Pull up a chart. Today is a really, really good example of why you have to look to buy low, sell high, and scalp. Breakouts, remember, breakouts occur on at least, it's safe to say, about 70% of the bars. So when you have a breakout, you have a big bear bar here, and then you get a couple of legs down. The more you go down, the more you enter the buy zone. And because of that, the greater the risk you get a reversal. So let's think about that for a second. Here, let's think about the logic behind a trading range. Here, we have a trading range. By the time it's clearly breaking out, if you wait too long, if you wait to sell a big bear bar, like here or here, anywhere in this area, you're buying, right? You're selling in the lower 1/3 of trading range. And because of that, the risk reward is terrible. If you sell up here, so if you sell in this area, where's your stop? Your stop's probably going to be somewhere up here. So your stop might be somewhere in this area. And because of that, if you're short and your stop's up here, the risk reward is awful. And if the risk reward's bad, what that's going to do is force traders to have to scale in. So the more you sell at extremes, the more you have to scale in. And the reason for that is by the time it's clearly bearish, what's happening? You're having traders buy. So if you remember back to the market cycle, this is the reason why in a trading range you have to buy low, sell high, and scalp. By the time the market is clearly bullish, or bearish in this case, say you have a sell off here, it pulls back, sells off again, pulls back, and then sells off. You may think by the time it's bearish, maybe it's somewhere here in this area. The problem with that is if you have a trading range and the market rallies, pulls back, and rallies up here, you're selling right in this area down here. And that's going to be the buy zone. So the buy zone is going back to this chart. The buy zone is going to be somewhere in this half of the chart. The sell zone is going to be somewhere in this area. The way you identify the buy and the sell zone is looking at the prior leg. So here's the high, here's the low. The sell zone is going to be the upper third of the leg. Whenever you have this sell off here, the sell zone is the upper third of the leg. And the problem with this all goes back to the market cycle. You have to think about the market cycle from the you have to think about breakouts from the standpoint of context. And this is again, I cannot stress this enough. When you're in a trading range, these are three simple rules. When you're trading, especially in a trading range. Leg one, look for second leg. Leg two, you can enter betting on a third leg. But exit below strong counter trend CT bar. This is the most important. Leg three, do not trade with trend. So this part here is what screws people up in trading ranges. By the time the market is clearly bearish, it's usually the second or the third leg down. And because of that, it increases the likelihood of a reversal or a deep pullback. You get a big bear breakout here, but it's a second leg down. Leg one, pause. Leg two, traders will sell it. And then here, same situation. The reason is you have traders, instead of selling new lows, they're entering on pullbacks. So again, the overall issue is when you're trading breakouts, you have to remember the market cycle. When you're in a trading range, that trumps every reason to buy high or sell low. The only time traders will enter is what's best is when you have a tight trading range, you have a strong downside breakout like 48, and then you get a strong reversal 49 and 50. It's arguably the middle of a trading range, but it's leg one. And leg one often leads to a second leg. On another time frame, so let me back up. Someone said there's no sound. Strong breakouts, they need follow through. And the reason breakouts need follow through, the reason is Markets are fractal. So if we think about the logic behind that, what that means is if we go to a chart and we look at this bar right here, bar 11, on some time frame, bar 11 is a good looking bar. But the issue with bar 11 is, let's say on a 1 minute chart, you have a big bear bar closing on its low. However, the issue with that is look to the left. So if we look at this bar at 925, I'm going to look at a 15-minute chart at 925. It won't be that easy to do, but if we go over to here, you can see. Do you really want to be selling even if this bar closed on its low? Do you really want to sell it? It's in the middle of a tight trading range. And the reason breakouts need follow through is it takes a lot of energy to break out of all the bars to the left. This rally here can easily reverse down and just be a big tail. So if we look at this bar, bar 54 yesterday, which is at 12:55, so 1 o'clock, that's this bar right here. Big bear bar and a 2-bar reversal, but it's in the middle of a tight trading range. So big breakouts, they need follow through because it shifts a lot of the market cycles. In general, if you ever want to see if a breakout is strong, the easiest way is to look at a higher time frame. So if I want to see if we had a strong rally, look at a 15-minute chart. Does any of the price action over the past few days look strong? No. We had a series of trading range bars. We had a downside breakout here and then an upside breakout and sideways. So what that means is breakouts need follow through and breakouts must do something else. The follow through needs to change the market cycle, which is basically the same thing as context. You need something to change about the market. Otherwise, if we just go back to the past few trades, really today and yesterday, all of these bars, when we look at it, nothing is changing about the context. Big bull bars, it's testing the top. Big bear bars, it's testing the bottom. So if you look at a 15-minute chart or a 30-minute chart or a 60-minute chart, and you see that obviously price action's bullish, then what I mean by that is if you go back to over here, if you look at this and you get this big rally up to bar 61, and then you look at a 15-minute chart of the same price action, this was on the 18th. If we go back over here, you can see it created lots of big bull bars on the 18th on a 15-minute chart. That is going to increase the probability that you get a strong second leg to the upside. So the key is the follow through. When I see follow through on a breakout, I need to see lots of the market closing beyond a lot of bars. So let's look at some more examples. Here, big bull bars, but look to the left. Big bear bars here. That's strong. Now it's getting stronger. It's probably going to get a second leg. The other thing to think about with breakouts is when you get something like this, that's one big breakout bar on a higher time frame, like a 15-minute chart, and it's going to increase the probability of getting another leg down. So if breakouts need follow through, what are some characteristics of follow through? Who can tell me? What's characteristics of strong follow through bars? One is One is little to no overlap. Follow through equal to the size of breakout bar. Now, these are obviously assuming that the bars are going to be big. Gaps. So gaps are open, and open gaps obviously create trapped counter trend, which we call limit order traders. So let's look at that for a minute. If we're going to categorize it in order, what's a way, if we take what I just said, what is a way that we can measure a strong breakout? Who has some ideas? If we think about this section, so if we just pause for a minute, what's something we can take home with today and think about? For a strong breakout, or let's just call it a breakout setup. Here's one idea. We need first a strong breakout, and let's just say we need a strong breakout. We can define that in a second. Number two, we also need follow through. And then third, who can tell me what's something else we could use? So we have the breakout, we have follow through. The third is a micro channel. So third, micro channel. Let's think about that for a second. This means one setup, we'll just call breakout setup number 1 is a 3-bar micro channel breakout. So let's take a look at a chart. Why is a 3-bar micro channel relevant? If we look at that, if we have a big bull bar and follow through, and it's creating a micro channel, chances are what it may create is a gap. So if we have a big bull bar on 41 and then a big bull bar 42, and we look at the follow through, which is 42, because 41 is breaking above 40. If we look at the follow through on 42, and we can see there's an open gap, low of 42, and the low of 40, this bull bar right here, what we can see is it's creating an upside breakout and it's creating an open gap. That will increase the probability of something specific happening, and that's trap traders right here. So if you're a bull, if we think about this, here is, this over here really quick. Here's this chart. And we have a few things going on. One, we have here the breakout bar, here the follow through bar, and then we also have a gap. which is right here. Both of those reasons, and it's doing something else. It's breaking out of a triangle down here. So this is a strong enough breakout that there's probably going to be buyers below. So it's a bull breakout, probably buyers below for a second leg. And if you look at several charts, you'll notice 3-bar micro channels happen pretty frequently. And you can do it in a series of ways. Look for 3 consecutive bars in a micro channel, 1, 2, 3, and wait for an open gap. Here, there's no open gap. So how can we, maybe we wait for another bull bar here. 1, 2, 3, maybe 4 consecutive bull bars, strong enough rally, maybe you buy for a second leg. Another idea, which is here's an even easier breakout setup to think about, is, and this is one of my favorite kinds of breakouts. If anyone can guess as I'm writing this down, I will give you brownie points. My favorite breakout is, how do I want to call this? A breakout plus follow through of the EMA. So what does that look like? It's going to be the exact same logic here. We have a breakout, number 1. We have to have follow through. And then 3, it's got to be beyond the EMA. So what does that look like? The EMA, one of the greatest things about the EMA is it will explain what is going on with the market. Flat EMA equals a trading range. However, if we start to get even something like this, here's the moving average. We've been down for a lot of bars. We get a strong bull breakout with follow through above the EMA. Guess what? Probably going to go a little bit higher. To me, my favorite examples, you can see it last Thursday on this chart, really 2 Thursdays ago. Actually, this was the 18th. It was last Thursday. What I want to see is this green box and this bear bar. So if we look at this chart here, we can see the example. I want to see some sort of, and just to be clear, I want a leg 3 reversal. So what does that mean? I want the market to be always in short with some sort of leg 1 here, maybe leg 2, leg 3. So I want to see leg 1, leg 2, leg 3. Then I want to see a bull breakout with follow through above the EMA. And you can see it happen right here. Ideally, you get a close breaking far beyond the EMA. So what does that mean? Who can tell me? Why is the EMA significant? There's a simple reason behind it. By the way, leg counting is next week. So leg counting will be another big topic. And that'll probably be leg week. Or excuse me, next week. Exactly. It's an average price. So if you have the market, if the market's breaking far beyond the moving average here, and it's leg three, guess what's going to happen? You're going to go higher. Here, we're in a tight trading range. If this bar breaks far beyond the moving average, guess what's going to happen? You're going to get a second leg to the downside. So follow through, breakouts need follow through. But the key is it needs follow through beyond an extreme. So the reason why I like the moving average for to measure what that extreme is an example is right over here. We have a rally here. But look at the moving average going down. We have a bull bar right here. It's really common when breakouts get minor follow through. What happens is you get a big bull bar, you get a second leg, maybe a third leg, but then look, the market couldn't stabilize above the moving average. Now, what do you notice about here? 28, 29. The market's breaking far beyond the moving average. Therefore, far beyond the moving average with follow through and gaps. What does that do? Go back to my example here. When you get a bear breakout like this, a lot of bars above the moving average, and you get a strong breakout, or you can say this is the follow through bar, maybe on a 1 minute chart. When you get a strong breakout bar with follow through, it traps everybody and it's changing the market cycle. So, kind of a review, the market cycle, an easy way to tell what the market cycle is to use the moving average. So, that is a very important thing to understand. Just look at several charts. If we're looking at charts in general and we're scrolling to the left, if the bars are all above the moving average, guess what? This not going to lead to a strong breakout. Who can tell me what's wrong? What's wrong with this right here? Bar 43. Who can tell me? Exactly. Good job. Bar 43 is not breaking far above the moving average. And if it's not breaking far above the moving average, that means the market's going to probably fail and lead to more sideways trading. Here, even right here, we broke above the moving average with follow through. It led to a small second leg up. Now, an easy topic everybody should understand that is worth having a decent discussion on is trends are always trying to reverse. And believe it or not, this is exactly where most traders screw up. So trends always try and reverse. And the reason this is such an important topic, we have to go back to last week's session. And that is this right here. The 80% rule. 80% of the time, the market's going to continue to do what it's been doing. So let's go to a chart. What's the easiest way to tell if the market's in a trend? I've said it several times, and that's exactly right. It's the moving average. When the market's far above the moving average, what's the number one thing you should do? What does Al say about reversals? Wait for pullbacks and test beyond the moving average. The way I like to think about it is this: if the market has been strong enough to be above the moving average for a lot of bars, let's say it's been 20 bars right here, and let's ignore the fact that the market's been above all these bars over here. If the market has been above the bars, above the moving average for more than 20 bars, what that means is the bulls are strong enough to make the market above the moving average. In other words, they're paying a premium above the average price for a lot of bars. And because of that, if that's the case, what that's going to lead to is, what do you think those traders are going to do when the market gets to the moving average? They're going to buy. So, an easy way to think about that is, when you're looking for a reversal, you need price to be under the moving average. I need to see the bears go beyond the moving average. Otherwise, I'm going to assume this rally is going to last forever. And that happens all the time. Here, lots of bull bars above the moving average. Looks like it's going to reverse, and it never does. It just continues to go higher. Look right here. Lots of bars under the moving average. Finally broke above it, but still had to get to a new low. Here, breakout. What do you call this pattern right here? Who can tell me? As I'm saying this, bars 27 to 29. Comment on what that pattern is. I just talked about it a few minutes ago. It's one of my favorite breakouts. We had a bear breakout. We're holding below the moving average here. We tried to get above it here, tried to get above it here, tried to get above it here. So what happened right here? What was the issue? We couldn't get bars completely above the moving average. Yeah, it's a micro channel down, and it's a bear breakout closing beyond the moving average with follow through. So it's shifting the market cycle. This is the issue with trends. They keep trying to break above, trying to break above, trying to break above, and eventually they fail. So trends, the key is trends are always trying to reverse, and most of the time they fail. So there's a few things we need in order to. There's really two ways we can think about it as, what do we need to see a trend fail? So I'm gonna take this, move it over here. Who can tell me what are those two things we need to see? There's two ways. And by end, what I really mean is pause. For a trend to end and go sideways, so pause is another word for trading range. What we need is either a MTR, which we'll talk about soon, which is a major trend reversal, or we need some form of a sell climax in a bear trend. So CX means climax. So after a consecutive sell climaxes here, breakout, another leg down, we get this big sell vacuum that often leads to a lot of sideways trading and ultimately a reversal. And the reason that happens is you have traders selling the breakout, betting on another leg down. Here, this sell off's tight enough, you're probably going to get another leg down. Same thing here, tight bear channel, probably a third leg down. But eventually, everybody sees this as a trading range. And because of that, traders want to see when there's excess to the move, because everybody, there's a saying, with markets or Wall Street, that traders don't know They know when the market has gone too far in the sense of excess. So when the market's climactic, it's obvious when it's gone too far, but you don't quite know it during the time. What I mean by that is traders want to see something big. This, let's go to a better small pullback trend. Here, small pullback trending behavior, bars are all about average, average bar here, average bar here. Eventually, you get, look at this, bar 77, big bull bar, many times the size of all these other bars. And what it's doing, it's creating excess and it's increasing the probability that we start to go sideways. Here, tight bull channel, you can call it a small pullback trend at this point if you want. Big bull bar, it immediately reverses. This big bull bar is signaling the end of the small pullback trend and the evolution into a trading range. So the key for trends, really the most important piece is major trend reversal. So what I want to see is right here. I need to see this piece here, a major trend reversal. Traders will save themselves a lot of trouble if they just avoid major trend reversals. And if they just avoid fading trends. So what I mean by that is here, when you're in a small pullback trend, until you get a strong breakout and a retest of the highs, do not take the trade. Here, when the market is in a trading range and it's going above and beyond the moving average, it's really better to look for wedge tops and wedge bottoms. If that doesn't make sense, make a comment. Now, most of the time, this kind of gets into another section of breakouts. This kind of gets into the next section of, excuse me one second. There we go. I checked some on the mic. The next section, breakouts, begin small. The reason why this topic is so important is strong breakouts cascade onto higher time frames. Easiest example is down here, bar 48 on the 18th. If we look at a 60-minute chart of the 18th, we can see it right here. We have a trading range, big bull bar. This big bull bar is a higher low major trend reversal on this chart, and it led to a series of strong bull bars. And the easiest way I like to think about that is if I can flip to a higher time frame and see this exact move. So if we go to, let's just say we're looking at this day right here on the 18th. So I'm going to type that in 1/18/24. If I look at this chart here and I look at this rally and I see a lot of big bull bars, this is a higher low, strong breakout. It's probably going to lead to a second leg up. And because of that, I look at a 60-minute chart, consecutive big bull bars. That may lead to a second leg up. Same thing here. This rally here, what do you think happened on the 8th? It started with a small breakout. So if I go to the 8th of January, look what happened. starts with one bar. And if you understand the prior bars to the left, you understand we have a wedge right here and we have a rally. There's the first 12 bars of the day right here. These 12 bars lead to this bar. Then, so what's key, and this is what screws people up. All the time I hear people make this comment, oh, it's a wedge. 1, 2, 3. It is a wedge, but it's open gaps. Whenever you have a wedge with open gaps, it's a warning that it's a tight bull channel and it's a breakout on a higher time. And the key you can see right here. We keep getting more and more bull bars. So it cascades into a rally and another leg up. That is really the most important thing to understand with the last section, or at least part 2. And that is breakouts can begin small. So if we go back just for a quick second, breakouts can begin small. The more a breakout grows, the more it will impact the higher time frames. That's really all you need to know with the last part. Next, this is probably the most important thing for breakouts. Video 15. So who can tell me? Breakouts lead to what? So I'm gonna go back up here now. Kind of start over a little bit. Draw a big line. So this is going to be video 15C for those following along. And I just gave the answer. Breakouts have second legs. Very important. Why is this topic so important? The reason is second legs are the fundamental reason traders will trade a breakout. How many breakouts have second legs? Who can guess? I'm going to look at today's price action to talk about this. So how many breakouts get second legs? What percentage? And when we're looking at today's price action, if we go to, here we go, more than 90%. I would argue that the majority of breakouts easily get second legs. So let's just take a look and let's just quickly look at 20 bars. Here, big bear bar, and then a breakout below bar 1. That's a bear breakout. Did bar 1 get a second leg? Sure. The second leg was here on bar 8, or it was bar 11. So what about these other breakouts? Bar 11, it got a second leg down on 15 or 16. 15 or 16 got a second leg down on 22. If you look at even 25, attempted to get a second leg down with 27. Now, the point with all of this is the more the breakout closes beyond an extreme, the more likely, the bigger the second leg is going to be. Big breakout here, the second leg, it tried to be 53, ended up being this right here. So we have breakouts, they often have second legs. We understand that piece. Now, the key with the reason why second legs are important is breakouts breakouts like symmetry. So who can tell me, what does symmetry mean? When you think about symmetry, it's leg ones equal leg two. So leg one equals leg two. Now, the key to understand with this is not all breakouts get exactly a second leg that's as symmetrical as the first leg, but they often become really, really close to getting a second leg. So we have a rally here, the low of 38 to the high of today, test down here. Guess what? It got the second leg. The reason why you have to understand breakouts have symmetry and they want generally to be symmetrical or the same length is this right here. It's common for the market to get a breakout, pull back, and a second leg. But then, whenever the market starts to rally and it starts to get a strong breakout and follow through, you always have to question if this is the second leg. In other words, the second leg can be higher. Trading ranges have this is something to write down in your notes. Trading ranges have delayed second legs. Bear breakout, pause for a bar, second leg down. Bull breakout, pause for several bars, second leg up. Bull breakout here, sideways for several bars, second leg. And we'll talk more about that with leg counting. Bull breakout on bar one, pull back three, second leg up. Bear breakout on seven, pull back eight, second leg to the downside. So breakouts, all in all, have second legs. And the reason they have second legs is very straightforward and simple. Nobody is going to buy the close of 42 or 43 if they do not expect the market to go higher. And because of that, and by the way, I'm just talking briefly about these concepts, breakouts and second legs. Once I talk about leg counting, we're going to piece together breakouts in regards to leg counting. So remember what I said in the first, maybe the second video, so last session? I said the three most important topics to understand are you got to understand the market cycle, you got to understand breakouts, and you have to understand second legs. If you can understand those pieces, then you can start to piece together the market cycle and how it operates. So remember, everything goes back to this right here. This is the fundamental piece of trading. Breakouts, they lead to trading ranges, and a trading range gets a new breakout and starts over. Channel, that's a transition point. So back to what I was saying. As far as second legs go, the reason why the market gets a second leg is because traders, they're only willing to buy either here, the rally 63, 64, if they expect the market to continue to go higher. So traders are only willing to buy here if they believe they can buy a pullback, scale in lower, and get out break even at their first entry, or the market will continue to go higher. Daily chart's a good example. Traders are only willing to buy December 28th here if they believe they can scale in lower and exit at their first entry, or if the market will go higher. Otherwise, you wouldn't trade a breakout. If you knew the breakout was going to fail and it wasn't going to get a second leg, you wouldn't trade it. So someone asked, how do you distinguish between a delayed second leg versus disappointing follow through? Delayed second legs are trading ranges. And who can tell me, this will be actually a really great, this is a great quiz question. Why do delayed second legs happen? So I'm going to take your question. Let's think about that. There's two reasons why. I'll just talk about it briefly. The reason why delayed second legs happen, if we go back to here, so if we go to second legs, yep, okay. Nate is in the right direction. So let's think about second legs. When you're in a trading range, it is forgiving. So trading ranges are for giving to limit order traders. Trends are the opposite. So trends are not forgiving to limit order traders. So why is this relevant? This right here, these two statements explain second legs. How can these two statements explain second legs? Second legs, the way a second leg responds is due to trap traders. If you remember, we talked about earlier. So trapped traders lead to second legs. This is the basis of breakouts. So this is why traders trade breakouts. And again, I'm expecting everybody here to have already watched the videos on breakouts. So right here, this topic in a trading range, back to this person's question, how do you distinguish between a delayed second leg versus disappointing follow through? You distinguish it by who's trapped. So strong breakouts trap traders and lead to second legs. I've often joked about this, and I say it in a joking manner, but most traders, you should try it on simulated. Try to fade everything. So you see a bar, buy below it, and then you see, let's say you see up here, you start selling above bars, scale in, make a scalp, buy below here, scale in, make a profit, buy below 12, scale in, make a profit, and just keep scaling in. Eventually, what you're going to do is you're going to sell, scale in, and you're going to get trapped with 44. And then you're going to get trapped on 50, and you're not going to be able to avoid a loss. And what's going to happen is you're going to hang on to the trade, and all of a sudden, you're going to get this strong upside breakout that's going to trap traders. So the reason why breakouts in a trading range lead to delayed second legs is because it allows traders who sold here and scaled in higher to exit break even. It also tests breakout points. If you remember in the trading room, I mentioned that traders, I thought the market on 49 had to test the high of 30 of bar 31. That's because it's the same concept. The market is trying to test the breakout point and allow those traders to get out without a loss. And that the allowing traders to get out without a loss, even if it's break even on the entire trade, that often leads to sideways and then trend resumption. And the bulls know that. So a lot of bulls, they see the breakout points here. They don't necessarily want to buy up here. They want to buy the pullback. Some bulls want to buy at the breakout point, betting on a bounce. Nate says weak buy bars usually get tested. That's exactly it. The weaker the buy bar, the greater the probability of sellers above the bar. Now, the last piece to really understand about video 15C and breakouts getting second legs is the bigger the second leg is, the more it can reset the breakout. And I'll talk more about that with leg counting, but the point is here's a bull breakout, 36.37. However, if we look at this chart, you can argue 36.37 is a second leg from 21. However, as the market starts to continue to go higher, at some point you have to conclude 36.37 is its own breakout, and then here 45, 46, 47, 48. This is a new breakout. It's not a second leg. Strong trends keep resetting the breakout. So a way I think about that is you have a bull trend line break into a channel. The channel tries to break out to the upside, forms a trading range, successfully breaks out to the upside, forms a trading range, successfully breaks out to the upside, pulls back, forms a trading range, and it keeps repeating that pattern all the way up. And on a higher time frame, it leads to a strong upside breakout. So again, the next topic is trading range breakouts. So my first question to everybody is, why do trading range breakouts often fail? Who can answer that? Why do trading range breakouts often fail? Faders, okay. I'll accept that answer. Faders, profit taking, market inertia, limit orders, trap traders, momentum. Yeah, exactly. So the reason why most of the time you have trading range breakouts that'll frequently fail is because most of y'all have the question right. The reason why trading range breakouts fail is limit orders. Remember, the fundamental basis of a breakout, trap traders leading to a second leg. If nobody's trapped, then the breakout is not going to go that far. So if we go, and that happened today all the time. You can see it right here. We had this big bear breakout, and it's trapping bulls who bought above this high. And let's say the bears, they see the sell off. And let's say these bears, let's say bears sold the close of this bar, and then they see this big bull bar here. Okay. Did that trap a lot of bulls? Not necessarily. And then what happened? The market reversed back down. So anybody who bought anywhere up here and scaled in lower below one were able to avoid a loss. Let's go to another breakout. Big bear bar here. What about all these bulls who bought up here? Are they trapped? They might be. Big bear bar here. It pulls back. Didn't allow all those traders out. It led to a second leg to the downside. What about the, let's find an example. Let's find an easy example. Let's look for something like this. We have a bull breakout on 41 closing above these bars to the left. Who can answer this? Is it easy if you sold the high of 39 here and you tried to scale in higher on 40, how could you make money? So if you sold the high of 39, and better yet, could you make money? Can you sell above 39, scale in, and make money? In an easy way that seems reasonable. Yes or no? Yeah, exactly. You can't make money. And so what happens is traders sell. They see this bar, they try to scale in, it doesn't let them, and then they start to get this rally. And all those traders start to buy back their shorts. Now, what are all these traders trying to do? These traders who are short here, scaling in, they're just trying to get out break even. And that's how I think about trading ranges. I'm constantly thinking about that. Okay, and I'm always putting myself in the position of both sides. Okay, I'm a bull. Let's say I'm a bear and I sold down here, I scaled in higher. Okay, the market's letting me out. I'm a bear here. I scaled in higher up to 30. Okay, what am I trying to do? Okay, bar third 35. It's a big bear bar. What am I trying to do? I'm probably trying to get out break even. And eventually, this is exactly why I talk about this chart all the time right here. Here, when I see a big bear bar, I remember this day. And that's why it's a very interesting slide to me. I remember I saw the wedge 1, 2, 3, 1, 2, 3, and actually remember this bar started going down and I tried to sell on a limit order. So on a 1 minute chart, here was the low. I tried to sell a pullback of maybe the first minute or two, and I could not get filled. It would go up a tick or two and then just immediately go down, up a tick or two and immediately go down. Finally, I had to hit sell the market on this bar. And I remember thinking to myself, this would be a really painful experience if the market, if you were long and you bought here, scaled in, maybe you scaled in, or you just bought anywhere to the downside, you almost had no way to avoid a loss. And so if you bought and scaled in once or twice, you would take a punishing loss. And I use that, if you go back to let's go to December 20th of 24. Remember what year it is? Here. What would you do if you bought with limit orders in here? You buy, you scale in, and then you see this. This is cascading stops, and it's stopping out a lot of traders, and it's shifting the momentum. And because of that, it's trapping traders, and it's going to lead to a big sell-off. And you can see it obviously did. Now, when we go back to today, very few ways. I mean, you got trapped here, 41, 42, but all through here, from bar 39 to most of yesterday's 15. If you bought, scaled in lower, you made money. If you sold here, scaled in higher, you made money. And because of that, you have not a lot of trap traders. And those trap traders, what that does is there's no fuel to the fire. So what I mean by that is I want to see fuel to the fire. In order to get a strong breakout, someone's got to get punished on the trade. And that someone getting punished are the counter trend traders. You have bulls trapped into a losing trade, selling here. and you have bears they're trapped out of a winning trade, and both have to sell to get short. So that's really the fundamental basis of breakouts in regards to why trading range breakouts often fail. They fail because limit order traders, and this leads to a side subject really quick, limit order traders make money. So, in order to understand breakouts, another thing that we have to understand is we'll add this to the right. What's the opposite of a strong limit order? Exactly. It's a stop order. So, bad limits order equals strong stop order. Now, what's a stop order? Stop order is a breakout trader. A limit order is a trading range trader. Now, obviously, you can take stop orders and be a counter trend trader. But the point I'm trying to make is when you have a stop order is the minimum, is basically a breakout. So when you enter on a stop, if I buy above this bar, let's say I buy above this bar 51 here. If I buy above it, I'm betting on a stop entry. And if the stop entry goes to the upside like it did here, what do you think the limit order traders are going to do here? So if we look at this chart and we slide it over here to here we have a stop entry. And we know there's going to be limit order traders right here. So these are limit bears. And we know that these bears, what are they doing? These bears here are selling, and they'll scale in higher here and then here. So they sell here, scale in, scale in. Now those bears are trapped. They see the big bull bar here, they see the follow through here. They're trapped into a potential losing trade. So what are they going to do at the original entry? They're going to buy back their shorts. So why did this not lead to a strong rally? Because of this bar right here. It allowed bears out. What did it also do? It allowed the bulls here to buy back at that same price. So nobody's trapped. Strong breakouts, what do they do? What about, let's take the same logic on 62. You buy, let's say you sell the 62 close and you scale in higher here and here. The market never came back to the 62 close. So it forced everybody to chase the market up. And you always have to be measuring the trapped traders. The reason why overlapping bars don't really go anywhere is because nobody's trapped. So if we just pick a random day, Let's look at this price action here. And let's see. This is a good example. Big bull bar here. Big bull bar. Well, if I buy the close of that bar and then I see a big bear bar here on 44, that's a big enough bar that it's trapping me. If I'm long here and now I see this reversal bar here, what am I going to do? Well, I'm going to have a bad situation. At best, maybe if I bought here and scaled in, I can get out break even, but I'm probably not trying to make a profit. And that increases the odds of getting a second leg to the downside. And that's why we got a second leg here. Why did all these bars happen? Well, what do you do here? If you sold the close of bar 10, bar 8 here, scaled in higher, you had one chance to get out break even here. You had another chance to get out break even here. If you didn't, the market quickly reversed here. This bar trapped the bears. It trapped the bears and led to a second leg up. By the way, as far as questions go, some people are asking if I'm going to answer questions. I'm reading the questions. I want the questions to be related to breakouts, not about specific trades. So today, the reason why a lot of these breakouts fail is it relieves trapped traders. And you can see that all over. If you're a bull, if you buy the low of this bar here, you scale in lower down here, look what happens. The market reverses up. And I have several PowerPoint slides of that. Here, what if you, this is actually this day, what if you sold anywhere in here? You quickly got into a losing position. I go to this area. What happened here? The bears, this is a 60-minute chart. You had bears that were short here. Those bears, any of the bears who didn't get out down here and they held to the upside, how do you think they're feeling? They're feeling like they're in a losing position. So those bears, what are they going to do on a pullback? They're going to be desperate trying to get out, break even. Look over here. Big bear bar to the downside. These bulls that are long from up here and they scaled in lower here and here. What do you think they're doing up here? They're thinking, wow, that was a really bad area to be long. I should sell. And the bears know that, so the bears are selling as well. If you sold here, bear breakout, if the market starts to pull back here and here and here, well, guess what? If you're short, you're going to get trapped into a losing position. If I sold this bar right here, I'll zoom in for you. If I sold this bar here, scaled in once or twice, if I don't get out quickly, this could reverse up rather fast. And that is a pain trade. In a, so in a trading range, buying happens in reversals from the lower third, isn't it? Not sure exactly on that one. Reading through some of the questions. So while I'm doing this, who can tell, what are some questions? What's confusing about the breakout videos? Exactly. Jay, this overlap revisits earlier entry levels. So who can tell me while I'm reading through these? What is confusing about breakouts? Now, we talked about second legs in video 15C. And in order to talk about second legs, most of the time we know that second legs, they lead to a third leg. But in order to really talk about second legs, we also have to talk about an important subject, and that is failed second legs. So if we think about, here's video 15D, what's a failed second leg? Second leg trap. Second leg traps are very common in trading ranges. And I'll talk more about leg counting in the following week. Here's the issue with second leg traps. So let me just do this. Show a few examples. This is a really common situation with second leg traps. Big bear bars here, and you sell it, but the issue is you had prior buying pressure over here. So a trader, if they sell down here and there's prior buying pressure, guess what happens? The market reverses here up to these highs and then immediately tests down. Second leg traps are common in trading ranges because it's typically delayed. You get deeper pullbacks than what traders want. However, the probability is high of getting some sort of a retest. A simple rule I have regarding second legs in trading ranges, and this is just something to note. I'm going to write it down. And that is, so here's part one, second leg traps. When you're in a possible trading range or channel, if you were long during the second leg, exit below strong bear signal bar. What does that mean? And why should you do that? The reason is second leg traps, they trap scale in traders. So if you're a bull, let's find a second leg trap for a minute. This is a good example of a second leg trap, bar 72 yesterday. What happens is you have bulls who are long, and those bulls scale in lower. High probability of getting a retest up here. However, here, this is a second leg. The market does not always get a third leg, especially in a trading range. And so when you get the second leg up to here, guess what happens? It's really common for the market to sell off and test near the bottom of the second leg and then go sideways. And that is basically second leg traps. Look over here, several examples of second leg traps. More or less, that's pretty much the same example. Let's just look over the past few days. What do we call this pattern? Leg one, pull back, leg two. It's a second leg trap. So whenever you get a strong rally and you look and see there's a lot of overlap, it's a possible second leg trap. And what can happen is this right here. You can have a big sell off, test to the lows, and in this case, it was three legs up, 1, 2, 3. So if you're buying and you buy more here, unfortunately, you had to hold through a deeper pullback, but ultimately the market retested the second leg. Second leg trap, sell off, pause, second leg down, and look what happened. The market ended up actually not even testing the second leg. So second legs to me are they're trading ranges in essence. You get a sell off down to here, a leg in a trading range, and then you get a sharp move down. And typically what happens is because the whole market is already in a trading range, it'll reverse and test back into that area. And again, all of this is in the video course. So where's another second leg? Does anybody see a second leg here? Second leg trap? Yeah, bar 60. The market rallied here. So this is actually a second leg trap to 42. Deep pullback, retest the highs. And then bar 60 is a variant of a second leg trap. Deep pullback and then a second leg to the downside. Second leg traps form trading ranges. And that is one of the most important things to understand. So there's not really a lot to it, but the point is it's best to scale in the direction of the first leg. So when you get a strong sell off, that's leg one. That's high probability you can scale in for a second leg down. When you get a second leg down here, it's lower probability to scale in. Big bear bars, 8 and 9, high probability of a second leg. When you get a second leg down, 13 and 14, lower probability of a reversal up. But again, more of that will make sense when we talk more about the market cycle. All of these surprise moves are basically variants of second legs. Big sell off, deep pullback, big bar 43. It's a classic second leg trap. You get a big bear bar to a new low, but what's really common is the market will rally back above the highs and then retest the lows of the second leg. So, again, we will talk more about that. How do you decide whether to buy a breakout of a trading range for a second leg compared to buy low, sell high scalp in a trading range? It's all the same. So here, when I see a big bear bar and then a pause and then another leg down and then a pause and another leg down, whenever I see a wedge, guess what I'm looking for? I'm looking for a two legs sideways to up in the evolution in a trading range. So if we think back to the market cycle, here, what I want to see is if I'm in a trading range, say this entire box is just a large trading range, and we add a couple of legs to the upside, and then we add a sell off here, pause, another leg down, pause, and then another leg down here, and then maybe we're starting to go sideways, and then maybe we got an even the third leg down. What I often look for is I want to see some kind of decent reversal to the upside. So betting on a couple of legs to the up, sideways to up. So in other words, bull bar, and then maybe a rally, pullback, second leg. So here, one, and I want to see a lot of overlap. I know in that line chart, it wasn't showing as much overlap, but I want to see a lot of overlap and then some sort of rally breaking above a trend line and then look to buy a pullback. Where do you place your trading range in a stop? We'll talk more about that soon. Again, this is more going to be on the discussion of breakouts as a whole. So we'll talk more about that. And then let's go back here for a second. So, what are, lastly, signs of strength in a breakout? Let's talk about that for a second. The first sign of strength in a breakout, who can tell me? It's one word, or two words technically. What are signs of strength in a breakout? There's a two-word answer, one or two words. Starts with an O. Yeah, it's overlap. So when I'm looking for, I'm looking for a sign of strength in a breakout. Let's just make it a little bit thicker. So the first one is overlap. What's another sign of strength? Exactly. Gaps. Big bars that are greater than average, but not too big. So there's a few examples. You want large bodies, small tails, close beyond extremes or beyond several bars. Yeah, these are some fairly straightforward signs of strength. And when you look at them, all of these lead to one thing. Because what you have to remember about trading, when we look at this, these are just words. And what you really have to think through is the logic behind everything. Everything in this video course, all of these videos here, market cycle, everything here has logic and meaning. So when I scroll through all these videos, there's logic and meaning to why something is happening. And it all boils down to what traders are trapped and who is making money. So when you have very little overlap, like what I showed earlier with this slide here, it's going to go lower. Here, very little overlap. Guess what? It's going to go higher. And if I said overlap, what I mean by that is someone corrected the error to what I said. Little to no overlap. That is what I meant. When there's little no overlap, when there's gaps, when there's big bars, but not too big. Why is not too big important? Who can tell me that? Large bodies with small tails, closing beyond several bars. All of those reasons lead to the market trapping more and more traders. In other words, we want to see this. We want to see the market continuing to go higher, and creating larger breakouts on higher time frames because those higher time frame breakouts will lead to larger swing trades. Talk about a daily chart for a second. Here's an example of a 2-bar reversal, and it formed a double top with the Aussie dollar, AUD, USD. This is what you hope for on cascading breakouts right here. We want this. We want this bar to lead to this several months later. Now, all of that starts with one, the smaller time frame bar. So if we go from, remember, here all the way to here, we got to go back in time. So let's go to July the 14th. Let's see what we notice. I'm going to remove all this. See what happened? Rallied. We went sideways. And what happened here? Who can tell me? In quick words, we have a trading range. I see one answer. Yeah, we had a trading range and we broke out below this range and we pulled back. Now, this sell off from here to here cascades. The breakout grows and gets bigger. Go to a 15-minute chart. All of a sudden, big bear bars to the downside. We go to a 60-minute chart. Before we know it, big bear bar, pull back, lower prices. We go to a 240-minute chart. Lots of bear bars. We go to a 480-minute chart. Lots of bear bars. And we go to a daily chart. And you get the logic. Eventually, breakout grows into a bigger breakout. We go to a weekly chart. And we can see it right here. The breakout rallied and eventually reversed and became bigger. But all of that cascades on higher time frames. Obviously, if you're looking at video 15D, let me just pull it up real quick. So if we look at video 15D, will the breakout succeed or reverse? There's a few things we need in order to really understand this question. So will the breakout succeed or reverse? In order to decide this, there's a few things we have to think about. One is market cycle. That's the first piece. In order to understand the market cycle, we have to understand leg counting. Those are the first two pieces. Then we can weigh after that, weigh the breakout to the reversal attempt to get this answer. So this question right here really comes down to, is the breakout going to get a successful second leg, or is the breakout going to fail and reverse the market? In other words, a breakout in the opposite direction. That's really what that comes down to. So, pop quiz for everybody. Why do weaker breakouts lead to deeper pullbacks? Who can answer that? Trap traders. No trap traders. Exactly. Weaker breakouts lead to deeper pullbacks because, well, for one, I mean, it is trap traders. So technically, trap traders and no trap traders, depending on how you want to answer that. Weaker breakouts end up retesting bars to the left. So let's think through that. Let's find an example. We'll use today's price action as an example. Here's a breakout. Two legs up in a trading range, micro channel up to 30. But it's in a bear channel, and bulls are making money below bars. That's a fairly weak breakout. It's done well in terms of distance, but overall, a lot of overlap and it's weak. And because of that, traders don't want to buy up here. Bulls, they want to buy a 50% pullback or lower, which is in part what happened here. And what do the bears want? Some bears, unfortunately, sold the high of 25 at 76 even, and look at the low of this bar, 76 even. These bears that sold and scaled in, they're making money right here. And that increases the odds that those bears who sold and scaled in, they're disappointed. They're going to buy back their shorts, and it leads to a second leg. That's different than what we talked about here a couple of days ago. Right here. Wedge bottom, 3 pushes down, bear sold. Guess what? They started scaling in higher and they all got trapped into a losing position. So weak breakouts have deeper pullbacks to allow traders out. And this goes back to that fundamental saying that trading ranges are forgiving. If you think about it, trading ranges, the market is always in a, let's go over here for a second. The market's always in either a trend or a trading range. Both are forgiving. Trading ranges are forgiving to limit order traders. And remember, this is counter trend, which other traders call, you can call it counter trend, you can call it anti trend. Same thing. Trading ranges are forgiving to counter trend traders. limit order traders, or excuse me, trend markets are forgiving to swing traders. So what does that mean? This means that everything is a polar opposite. So if we have let's think about this for a second. The reason why traders have trouble with the whole 40-60 rule, which we'll talk more about that in the future, is they have trouble understanding this piece right here. There's two sides. The market has two sides. On this side, here, it's in a trading range. And it's forgiving for limit order traders, which are counter trend traders. I'm going to draw a line right here. But it punishes trend traders. In other words, swing traders. It punishes swing traders. The opposite for a trend. It's bad for counter trend traders, which are both stop and limit order traders. That seems really simple, but this is an extremely important topic to really, really grasp. And the reason is what we're going to talk more about in the future is everything is an opposite. What's good for one side is bad for the other side. So this right here is very important. Trends forgive swing traders, which means it creates gaps and it traps the counter trend traders, which is why they go for a long time. Trading ranges are forgiving to limit order traders, but they punish the trend traders. So how do you decide how to buy a breakout high in a trading range for a second leg up versus selling the breakout because it's high in a trading range? Who can answer this question? I have the answer in front of me. Who can answer it? It goes back to the market cycle and leg counting. The stronger the breakout, the more it changes the market cycle. That's why I want everyone to really think about this setup. Think about breakouts crossing the moving average and the follow through. Bull breakout crossing the moving average, you buy, and you're probably going to get another leg up. Big bear bar crossing the moving average, you have trap traders. Bulls bought up here, bulls buy lower. They try to get out break even, leads to a second leg to the downside. So I'm going to take about 10 minutes or so and answer some questions. Before I do that, next week, what we're going to cover briefly is I'm probably What I'll actually want to do is I want to go back to pullbacks and bar counting. So I want everyone to watch videos 9A, 9B, and 9C. And I want to start with those videos because now that we understand breakouts to a degree, we need to understand pullbacks and bar counting more. This is a good question. What's a good breakout setup for beginners? I had it written over here. What I'd like everyone to focus on is this right here. Breakout plus follow through above the EMA. So find a breakout. And this is kind of the criteria you can think about. Find a breakout. Here, find follow through and have it go beyond the EMA. So like right here, we have a strong bull bar with strong follow through. Think back to the characteristics of follow through that we talked about here. Strong breakout, follow through beyond the EMA, and it's reversing leg 3. We'll talk more about that in the future. You can say this is leg 1. You can say this is leg 2. The point is, it is reversing the market cycle. So that's what I'd focus on. I think if everyone could try and build an idea off this right here, they would do extremely well. So I'd be curious if there's one breakout I'd focus on, it's this right here. Now these are going to be less frequent because most of the time you're not going to get a strong bar closing beyond the moving average with follow through, but it's a starting point. Big bear breakout beyond closing below the moving average, but it's not closing far below the moving average and it's not reversing the bars to the left. How many people here feel confident about breakouts as a whole? So I'm curious, when I say that, I mean the video series of breakouts. How many people, just yes or no, feel confident about understanding breakouts and how many don't feel confident? Okay, I appreciate the honesty here. Most people saying yes, that's good. How many people feel confident about understanding that trapped traders lead to strong breakouts and weak breakouts? So, in other words, when you have a breakout, you always measure who is trapped on the trade. Does that make sense? Because remember, what we have to think about is this is kind of how I think about this video series. A lot of people here that are looking at a lot of people that are watching these videos. We're on video 9. We're really on video 15 here. So we're going to talk about bar counting next week. I'll cover some last portions about breakouts, but the reality is we have not even gotten to all of this. We have yet to get to all of this. So, trading breakouts. Well, let me go up here. We have yet to cover any of this. Bull breakouts, how do you buy the close? There's going to be a lot of information in this. But in order to get there, we got to understand the foundational pieces first. So, what I really want people to understand right now, the most important thing I want people to understand regarding breakouts is trapped traders. Trapped traders lead to strong breakouts. So if traders are trapped, you get a strong breakout and it leads to something like this. If traders are not all that trapped here, it leads to a reversal. So, anyways, we'll cover more on that here in the future. So, for next week, go back to, let me just pull up the videos. Next week, go back to videos 9A through 9C and touch up on what I also want people to do is touch up on the last week's video session as well as this week. So make sure you understand the market cycle, the logic behind the market cycle. Understand that breakouts eventually lead to channels. Channels will lead to trading ranges. And then eventually you have a trading range that breaks out and goes to an opposite trend. In other words, starts over on the market cycle. Next, understand the breakout logic. Breakouts is one tick, is price going one tick above or below the bars to the left. And understand that a breakout is trapped traders. So in a trading range, the market's forgiving. And the reason it's forgiving is counter trend traders do not get trapped. And because the market is always a polar opposite, there's always a good and a bad. In a trading range, you have trend traders who get trapped, and the counter trend traders, in other words, the limit order traders, they are forgiven. In a strong trend, it's the opposite. Limit order traders get trapped, which fuels fire to the breakout and leads to higher prices. So thanks everybody for watching. And remember, next week, we're going to discuss pullbacks and how to bar count. In other words, how to count legs. And we're going to tie in together leg counting with understanding breakouts, because the way you trade a breakout is leg one, you want to focus more on swing trading. Leg two, it's a little bit more context dependent. In other words, second leg traps are the risk. Leg three, you're often better fading the breakout unless you're in a small pullback trending environment. But we'll talk more about that soon. Thanks everybody for watching, and I will talk to everybody soon.